Alrighty guys, what is going on? Welcome back to the Best Investing Money Management channel on YouTube. In today's video, I really want to talk about the total stock market crash. A lot of people right now are kind of freaking out, stating that we are going to have a crash, another, March of 2020, another 2008. And a lot of people are freaking out, stating that, oh my gosh, I'm just going to sell my stock and not even invest ever again. But there's a couple of things you need to understand before you sell and before you guys buy some more. So I hope you guys enjoy it. If you guys get anything in value out of this video, hit that like button, subscribe to the channel. If you have any questions, concerns, make sure you guys ask them down below. So looking at the market, right, you guys can see right here, this is the S&P 500 ETF. So the reason why this is one of these staple investments for people is because so much money gets fueled into this. The S&P 500 represents the top 500 companies in the United States that's publicly traded. You can see it has had great growth, very, very little volatility, but overall, it's just a staple investment for people that want to retire, for people that want to invest. It's a very, very passive investment. Pretty much you can just invest and not even have to worry about it, right? As of today, you guys can see the S&P 500 right here. You can see we've just had so much sell-off, right? The Dow Jones sold off 2.7%. The NASDAQ sold off 4.1%. The NASDAQ represents more of the tech-heavy side, right? The Apple and all of that. And then we had the S&P 500, which sold off about 3.6%, right? Which is one of the largest sell-offs we've seen in quite some time. Now kind of what's going on, right? Well, the past quarter was pretty much the earnings quarter, right? And we had a subpar earnings. I wouldn't say it was the greatest earnings we've seen. I wouldn't say it's the best earnings or the worst earnings. It kind of falls right in that middle, right? Where we had some stocks do actually very, very well and some stocks kind of do about average. Now, answering the question of why we're having sell-off, right? One of the main reasons why I personally think we're having a lot of sell-off is high interest rates. Now, high interest rates means it's very, very hard and expensive to get loans, to get money. And what this is going to overall have is a slowdown in the economy given sell-off from the S&P 500. If we actually go back and we look at this time period right in here, this was that March crash of 2020, right? We had a ton of sell-off. The total market fell about 40%, sold off. And then what the Fed did is they lowered interest rates to pretty much extreme lows. Now, this is when everybody was buying homes, everybody was refinancing their house because it was virtually free money. And we had an immediate buy up of the market, right? Within a couple of months, we were hitting all-time highs, right? In 1, 2, 3, 4 months, we were hitting all-time highs. And during this time, we had so much uncertainty in the general market. We had a lot of unemployment. People were getting unemployment checks. The unemployment rate was at about 9% compared to 3%, and it just wasn't very good, right? And we just had this continued buy up because of low interest rates. The economy was starting to open up again, and then we hit some highs here at about 478, pretty much the beginning of this year, and it really just started selling off. The Fed started to raise interest rates a little bit, which caused some sell-off, right? Not to mention unemployment right now is still right at about 6 to 7%, which is decently high, right? And one of the most sold off sectors that we've seen from is tech, right? If we actually go and we look at AMZN, the one and only Amazon has had one of the worst months that it's seen since 2008. 2008 was one of the worst financial crashes we've seen. And Amazon just had one of the worst months, and they are a huge contender to a lot of wealth and a lot of employment in America, right? And you guys can see the stock pretty much fell from $3,700 all the way to $2,400, over $1,000 per share lost, right? And another staple stock was Google. I'm a huge Google investor, and we've seen one of the worst sell-off since 2008, right? Went from 2,800 all the way to 2,200, sell off about $600. And for a company like Google, this is a massive sell-off, right? Just because of the volatility we've seen. Looking at their earnings here, if we actually go ahead and we can zoom in a little bit, it brought in about $68 billion. and an EPS of about 24, which is pretty decent, right? They bring in a lot of money. And another stock that actually still is performing very, very well is another staple investment is Apple, right? If we look at Apple beat their earnings, did very, very well, $97 billion EPS of 1.5, which is very good, right? We need this. But at the end of the day, is the market going to crash, right? I don't know. You don't know. No one can determine if the stock market's going to crash, but what you can do is be prepared, right? Well, what I always like to do is the very first thing I like to do is hold cash. Cash is king, especially in a recession. Okay. The second thing I'm going to do, I'm just going to continue to invest, right? Because nobody can determine if the market's going to sell off, if the market's going to go up or down. No one knows unless you have a time machine. So the best thing you guys can do is start saving cash, but continue your investment, right? And if we get that crash where the stock market sells off more than 20%, what I would recommend doing is start using some of that cash and start investing, right? Don't do the opposite and start selling, start investing. The reason why is because if we go back and we look at the S&P 500, right, the SPY ETF here, you guys can see during all these crashes we've seen, these are incredibly low numbers, right? And imagine buying at the lows. So once this recovers, you're going to be making a lot more money. Very similar if we actually go back and we can actually expand this here. The 2008 crash, for everybody that invested in 2007, as long as you had that long-term outlook, you're still up on your money. And if you would have invested during 2008, you'd have doubled, tripled, quadrupled your investment. So understand it's always better to just keep investing and not try to time the market. Timing the market's very, very difficult to do. It's better to have time in the market than try to time the market. I definitely think there is a lot of volatility right now in the general market. Tech is very, very shaky. We've seen companies like Netflix, we've seen companies like Facebook just get absolutely hammered for selling off, right? Just so much volatility in the market, and I definitely think go in with some sort of strategy, whether you just invest in the general market once a week, and then once the stock market crashes, then double or triple what you normally will put in and start using some of that cash. That's what I would do, guys. But overall, that is it. I hope you guys enjoyed the episode. If you did, hit that like button, subscribe. We will see you guys later. Remember to stay happy, guys. Stay positive. Stay safe out there. And we will see you guys later. Remember to stay happy. Take care.